Hello, everybody. Welcome to another episode of Life on Hard Mode with Pratik Karki. So, this week we're going to talk about VC math. No BS, no script, like always. Hope you all had a great Thanksgiving. And this week is going to be a little bit shorter because honestly, it's been a very crazy week. We are working two of the biggest deals right now, and honestly, I didn't get much sleep for the last few nights. So, trying my best to make this work because I made a commitment myself, which is let me do this podcast, let me talk with no script, no filler, and let me just be authentic and talk about things that I want to talk about. And I think a lot of people have expressed a lot of interest in this, and thank you for everybody who's tuned in, right? I think we're like at 100 subscribers. I've noticed the view hours have been ticking up consistently, so I'm very thankful for everybody that has been watching the podcast so far, even though it is rough and unpolished because it's only me and I don't do a lot of editing, right? There's no fancy graphics. I just use the tools that are in the platform Riverside to cut out some ums and ahs and maybe do a little bit of like layout changes, but nothing more than that. So I'm very thankful for everybody who sticks through with the podcast with all of the roughness that it has. So that being said, let's move forward. Welcome aboard again. This is episode number 4. This is by far the best no BS guide to raising capital and on how venture capital firms even work. The math behind venture capital operations is very mind-blowing, and I feel like too few people understand how it works, right? They see figures like XYZ founder raised 4 million and 40 million valuation, but what does that actually entail, right? Is the venture capital firm making money off of that? What is the end game? And how do they make money? Where do the funds come from? There's like a million different questions, and it's very worth being well informed in that. So we're going to take a deep dive over there. So if you're new here, hi, I'm Pratik. I'm from Nepal, and I co-founded Anthromine last year after working for a bunch of years at Google and AI and data. And I did this podcast. This is my 4th episode, so it's been like 4 weeks. And the main impetus behind this is I just wanted to share more of what we're doing, building in public, working in public, all of that. So if you're new here, thank you very much for giving me a chance. Really appreciate it. So the plan for today, like all weeks, we start off with some Friday positivity, and then I do the topic of the week. And this week's topic is how VC math works. No cap, no BS. And we're going to end with my favorite segment, which is what have I been reading, watching, / playing. For Friday positivity, I wanted to really talk about something that I feel personally, coming from Nepal, I see a lot of this, right? And the main thing is pleasing everybody means earning no one's respect. And the positive spin behind that is that you do not have to be liked or loved by everybody in order to be successful or to be yourself, right? In fact, if you try to improve yourself, what you'll find is a lot of times you will be actively disliked by a lot of people. And this is not to shame people. It's just like a natural human instinct, right? There's a very famous saying, misery loves company. And this sort of falls into that same realm, right? I put this image of crabs in a bucket. And if you do not know the analogy over here, being a crab in a bucket means that if one crab tries to climb out of the bucket and survive or see what's outside, the other crabs normally drag them down. So it's a very vicious cycle, kind of morbid. And there's a lot of that mentality going around. And I see it in Nepal quite a bit, right? I think in the US, there's some of it, right? But if you're putting yourself out there, you have the courage, you're very encouraged to do your things, right? To pursue what you want to pursue. I remember in Nepal, I was very much a jack of all trades. I was really good in studies. I put a lot of work there, but I put an equal amount of work in my extracurriculars. By that, I mean, I was like the basketball team, big thing over there. I believe I was like the captain of the basketball team in high school. A lot of extracurriculars. Really loved doing a lot of things like that, right? I volunteered at an orphanage for 2 years. But what's crazy is when you do these things, your family, teachers, whoever will be like, why are you wasting your time? Just, focus on this thing. Or like, why are you trying to do this? Or like, if you put yourself out there in any way, a lot of times you're shunned for doing that. And what that means is you do not have like a culture of exceptionalism, right? So the main takeaways here are, if you want to be successful, it's okay to be disliked by folks, even friends and family sometimes. If your family actively does not like that you're putting yourself out there, or like you're reading books, or you're not just trying to watch Netflix all day, then that means, it's okay to be disliked by them. Putting yourself out there and being cringe is actually part of the process of self-improvement. By doing this podcast, it is kind of cringe, right? I think a lot of my friends are like, oh, why is he doing this? Or like, why does he post on LinkedIn so much? But honestly, the amount of visibility that you get and the amount of brand name recognition that you get is really worth it, right? I will preface by saying that you should not be an asshole, but at the same time, don't be a pushover. What does that mean? Like, if you put yourself out there and step on a lot of people's toes, you have to make sure that you're not actively being disliked for the wrong reasons, right? It's fine to be disliked for, being out there, extroverted, cringe, whatever you want to call it. But if you end up becoming an asshole about it, then that's a problem. So try not to do that. And definitely do not be a pushover. Put yourself out there, fend for yourself, do not care what somebody else thinks, right? You do not have to explain what you're doing for your own progress to your family, to your friends, to your partner, whatever. And finally, it's okay to be different. I was very different growing up. I didn't think I ever fit in. And I still found my own circles, my own niches. I'm, very happy living a married life. So it's okay to be different. You will find your own circles and niches where you can thrive. So going to the topic of the week. This week's topic is all about venture capital math, how it works, no cap. So there's a few reasons why this would be of import to you, even if you do not work at a startup or whatever. There's a chance in your lifetime that you will found a startup, work at one, sell services and products to a startup, or work at a fund, right? Like even a college endowment fund technically works with startups. Not all the time, but like I have seen it happen. So it's a very good thing to know, and it's always better to be knowledgeable about a lot of things, right? And if you are working at a startup, you founded one, you are an employee over there, right? You're employee number one, you have like 1% of the startup. It is very, very vital that you understand how not to get screwed over and protect your own leverage, because in the business world, leverage means everything. If you do not have leverage, then you lose, right? Because the other person who has the bigger leverage always wins. And what do things like safes, preference tax, 83B election, QSBS, what does that even mean? I'll go through that. And what should you do in your particular situation? These are all amazing questions, and we'll go more into that in detail, right, in the next few slides. So before that, I wanted to highlight this tweet that I saw by Todd Saunders. Todd Saunders is like a great person. If you haven't followed him already, you should. Very direct, no BS way of talking about things. So in 2015, they raised $1.3 million on 4.1 million pre-money. What does pre-money even mean? We'll explain on that. And in 2024, they sold the company for 9 figures, or 10 million, I believe, or 10 million plus, 10 to 99 million. And the structure of that seed round mattered quite a bit. So 9 figures means 100 million plus, so massive deal, right? They had clean terms, aligned capital, realistic expectations, and investors who stuck with them for a decade. And I mentioned leverage, and this is why it's important. It's also called optionality, right? When you do your due diligence, you understand what you're doing really well. It creates this thing which is called optionality, or you get a lot of leverage because you have all of your ducks lined up in a row. You know where you're at, you know what the dilution looks like, you know what the preference tax are. So you give yourself a lot of options. So that's where you want to be. And that's why I want to talk about this, because a lot of founders actually get screwed over. You could see a headline of a company being sold for $250 million and the founders get zero. I think the most famous one, a recent example, is if you ever use this app called Be Real. They sold it a couple of years ago to a private equity firm for $500 million, but the founders made $0 from that, just because their preference tag was terrible, the valuation was pretty high and everything. You would assume that $500 million, the founders walked away like crazy rich, but in fact they walked away with $0. And it's actually not even that uncommon. Venture capital firms are amazing. I'm going to go into the history behind them, but at the same time, they can be very predatory, right? Because for them, all that matters is returning money to the investors. So they'll find a way to do it no matter what. So keep your cap table clean. Cap table means essentially who owns what percentage of what. And you also need to be very smart about your valuation. It's tempting to be like, oh, let me raise $1 million at 20 million valuation, which means, you're selling 5% of your company. And it seems very nice to do that, but there's a lot of drawbacks to that. There's quite a few reasons to have your company very well structured, right? You can sell it early and make a lot of cash. You can raise money very well if everything's structured very well. You can also just have a sustainable business, which is like a very good exit to have, right? Have a sustainable business, pay yourself, be your own boss. But, the fallacy that Todd brings over here is that so many founders are raising $20 million seed with no traction and virtually killing their optionality before they even start. So do not chase that high valuation. There's a lot of reasons why a lot of AI companies specifically do it, but at the same time, there's a lot of reasons why that's such a bad idea. And always think about the terms so that you give yourself the best optionality and the best leverage. So just to preface, right, the main thing you want to think about is do not worry about raising capital until you're solving a real problem. What does that mean? That means that most startups, right, in the beginning, when they're pre-Series A, Series B, even sometimes, they're striving for something called a product market fit. So a product market, right, means that your product meets the market demand in an amazing way. And there's no like true way of doing it, right? A lot of people describe it as a feeling. A lot of people describe it as essentially momentum for like a SaaS business, right? You could be making $20,000 a month. You could be losing less than 5% of your customers, and you could be growing at like a healthy pace. That could be an example of it. Or it could be just have a lot of daily visitors to your site and the amount of people converting to paid users are going up. So that is like the main thing you need to target. And it takes a lot of time to get there. But the early stages of startup are like trying to figure out if first you even have a market for that product, and if does your product solve the problems that the market demands, and lastly, are you able to like wiggle into that particular crevice really well and execute amazingly. So there's a lot of variables. I believe in the book Disciplined Entrepreneurship, they talk about like how a successful company is actually, A times B times C times D. What that means is like it's so many different things that are multiplied by each other, right? So you might have great product, you might have a great team, great market, great engineers. All of that have to be multiplied by each other. And the second one of them is a zero, like in real life multiplication, everything becomes a zero. The first few years or first stages of a startup are actually figuring out if you have a winner in your hand. So that's why they do a lot of pivots in the beginning, like a lot of Y Combinator companies, they only get chosen because the founding team is very strong, right? They're young, they're strong, show a lot of potential. And even the Y Combinator investors, right? The Paul Grahams or the Gary Tangs of the world, they know that the founder might change the idea, but what they're really looking for is the energy. So that's why they get founded, right? So the product market fit is what is very important. I will say for Anthramind, I think we are closer to the product market fit. We're doing a lot of great work, but it still takes a lot of time. I don't think until Series A, until like a while later when we have more and more momentum, I can say that. But I think once a lot of folks get there, they know that there's like momentum going over there. So that is one thing. You should not worry about raising capital until you really know you have a product that fits the market really well. Post-training data, great market for it, massive market, and our product is also really good at data platform. So we've been able to like sort of finesse and fit into the market needs really well in that intersection in the Venn diagram that I showed you. But there's still so much work that needs to be done, right? So let's talk about like the venture capitals themselves. How are they structured? And to preface, a venture firm's model for a fund is called a pooled model because you have to distribute the risk, right? So when you're talking about like a fund, like a general venture capital fund, it's actually it's called a limited partnership, and this area is what the fund is. So Y Combinator's fund would be this. This is where the money is stored, right? This is where they get like, let's say $10 billion from investors. That's where all of the money is stored. And let's take a look at who's actually contributing this fund. So ideally, the venture capital firm themselves are putting some money down. So let's say there's a $10 billion fund, right? Let's say Y Combinator's fund. Let's say the venture capital firm themselves are putting down like $500 million in this. This is just an example. And out of that, the general partners or GPs are also supposed to put personally some of their own money down. So if you're Paul Graham, you're Gary Tan, you probably have like at least 1 to 2% of your net worth in that to show that you have skin in the game, right? Otherwise, it's just playing with somebody else's money. And the majority of the funds do not actually belong to the venture capital firm. So Y Combinator does not actually own majority of the money that they get. But if the money belongs to the limited partners or LPs, so that's who Y Combinator sort of reports to, right? Their LPs. They could be like very wealthy individuals like Andreessen Horowitz's of the world, whatever, right? Or sovereign wealth funds, college endowments, like I mentioned, like Harvard is probably in a bunch of venture capital firms, for example. And all of them decide to build this general, like this partnership, and it's called a limited partnership. And the operators or the managers of those are the venture capital firms. And with that fund, the venture capital firm decides to invest in the companies. Let's say for the $10 billion investment, they invest into 1,000 companies. So they will put like bits and pieces of money over there, right? And what is crazy about this is that you would think that they would want every single company to succeed. And I bet they do, right? But they are realistically banking on 1 or 2 companies to go big and nothing else matters. So out of the 1,000 companies that they invest into, they might consider that one of them will turn into like a Tesla or a Databricks or an OpenAI, and that's where they actually make the money. Rest of the companies they assume will fail or barely break even. So it is a very, very crazy model. It is truly like one of the most interesting ways of structuring capital, but the results are pretty crazy. And that's why most VC firms follow this model of unicorn or bust. This mantra is something that's been around since the early days of VCs. The first venture capital firm, I think, was established after World War II in 1945. Before that, there used to be some notion of venture capital firms, but there's more like rich people, like the Rockefellers of the world, essentially backing existing businesses that are doing really well and reaping the rewards. The true venture capital firms only started in 1945. It was like an American Economic Development League or something like that. They decided to bankroll up-and-coming companies and pool funds together to de-risk themselves. And that's when it started. It's a very, very interesting story. You can read about it in the Wikipedia article about venture capital. It's all there in the history. And in 1972, the first Silicon Valley venture capital firm called Sand Hill Road was established. After that point, everything is like rest is history, right? Then it became like the venture boom, and venture capital firms came. A lot of them died. A lot of them are doing really well, like like the Khosla Ventures or General Catalyst of the world. Taking a look at the pie chart, right? What is their expected return on investment? They expect 50% of the companies that they invest into to return less than one times the investment, and most of the time it's a flat zero, right? They expect to get back literally $0. So they might put like millions of dollars and expect $0 back. A third of them they expect to break even. They get their money back. Maybe some of them get, it's a decent profit, right? But venture capital firms do not care about like 2 to 3x profit. 2 to 3x profit is amazing if you're like an angel investor. That is like what you hope for. But venture capital firms, and this one is even like very conservative, they would expect 1% of the companies to return them like 100 times or even 1,000 times or like 10,000 times return, right? Like I think PayPal netted the venture capital firms like 22,000 times their initial return or something like that. So that is how the true venture capital firm model operates. And it kind of makes sense. So if you have a fund of 100 million, 99% of them fail and 1% makes like, like a crazy amount, like 200% on the original return. They actually are up that amount from their original investment. And despite 99% of those companies, other companies failing. So that is how the math is. Unicorn or bust. So all to say, if you want to raise money from venture capital firms, you better be ready to become an unicorn or bust. There is no in between, right? It's better to bootstrap or raise from angels and be sustainable. then go through the venture rounds and essentially bust. Or either that, or you're either a billionaire or you're worth $0. So that's how the math works normally. So out of 100 or 1,000 investments, one company can give the venture capital firm 100 times in return of investment. Then that's a massive success for them. And think about the time frame as well. Venture capital firms have to return money to their LPs. LPs, if you remember, are the limited partnerships. Those are like the majority contributors to the funds. Your Kevin Durant's, your sovereign wealth funds, your rich people, and they normally have to return the money in 10 years. That's like the standard contract. It really depends. If it's a successful venture capital firm, they can extend the duration, but the wealthy individual is expected to put money down and get back all of their money plus a crazy amount, right? It's a high risk, high reward deal. So they're expecting to put down, like, let's say you put down $1 million, you want to get back like $1.5 million in 10 years or something like that. Or like even that $1 million becomes like $10 million. It's not unheard of. So venture capital firms normally have to return money within 10 years. And I will say this, I've heard that it's good to raise money from a venture capital firm when they are like midway between their fund. So let's say they've had their fund for 5 years. They actually need to deploy the capital and show signs of success before they return the money in 10 years. Otherwise, the money might just stay there stagnant, right? So I've heard that is a good time to seed capital, but take that with a grain of salt. All right, so another common question, right, which is what is a safe note? And the reason I brought this is a lot of people ask this question, right? One of the common investment vehicles for raising capital is a SAFE. And a SAFE stands for Simple Agreement for Future Equity. This was coined by Y Combinator partner at the time, I think in 2012. And here's why it's so powerful. And it's like a very interesting mechanism, right? So what the SAFE is it requires, just the baseline, it requires zero legality, right? I mean, the venture partner does some due diligence. They can like essentially wire you the money the same night and be like, okay, I wired you $1 million. You agree to give me 20% of your company stock whenever you raise the next round of capital. So it's a very, very easy way to do things without spending like tens of thousands or even hundreds of thousands of dollars in like legal fees, because that's what happens normally when you're raising a Series A. It's an absurd amount of legal fees. So if you're like a pre-seed company or seed company, you normally raise using a SAFE because that involves like very little paperwork. Pretty just as well, because you can raise capital, and if you do like a post-money valuation, you can know exactly what percentage of the company you own. So what is pre-money and post-money? So post-money means how much is the company valued along with the investment. So let's say you are raising $1 million at a $20 million valuation, right? It's important to know whether that new valuation is after you get the money in your bank or before you get the money in your bank. So if it is after you get the money in the bank, then 1 million out of 20, 5%, very easy to calculate. If it's pre-money, then it's like your company was valued at like 19 million, and after adding the 1 million, it becomes a little more jumbled up. So it's an interesting concept. I would recommend you take a look at it. There's a really good link over here by Cake Equity. Check that out, but that gives you more about it. But ideally, when you're doing a startup, Silicon Valley SAFE is like very common. You can go to Y Combinator's website and download the SAFE agreement right now. Even if you're an angel investor, you can like go and download it right now. It's legally binding. It's very widely accepted, and you can raise money very quickly. That's how pre-seed founders, that's how we raise capital. Just have a VC person wire your money after signing the SAFE, and the next time you raise capital or there's an exit event, it's called like a liquidation event, or I think it's just called like an event in general. Then they get shares based on that according to the new valuation. It gets a lot more complicated, but I'll leave that up to you. So it is quick and simple. You are giving funds to the company with the promise of getting equity or cash once the company hits X valuation. So if you write a SAFE for $50,000 at a 1 million valuation and the company gets sold for over 1 million, you get like $50,000 worth of, or whatever times the multiplier is. after that point. So it's a very easy way to raise capital. One caveat is that if you are raising from, let's say, a lot of angel investors and you have a lot of safe notes that are stacked, and not all safe notes are the same, right? You could have one at X valuation, you could have another one at like Y valuation, and so things get really messy. I'd suggest using a tool like Carter so that you can keep the cap table clean and really understand who owns what without it becoming very difficult. Otherwise, it's kind of hard to get funded if you do not even have your own cap table clean. So talked about the stages of a startup, right? Normally where you start is the pre-seed. And this is where a lot of people operate. Pre-seed and seed are where most people do the startup, and the startup dies because, you don't get revenue, you run out of money, you lose interest, you find a better job, whatever. So this is where majority of the folks operate. Pre-seed and seed, as I mentioned, you normally only raise in a safe. You do not do a price round. Price round is like buying a stock, right? You essentially decide on the price of the stock, and the investor buys that amount of stock. So, they might say like, hey, your stock is worth like $5 a share. I'll buy, $20 million worth of it, and there'll be an investment. So that normally does not happen in pre-seed or seed. Sometimes it happens in seed, but like in very like highly valued companies, or if it's like something like R&D, like if you're like a aircraft manufacturer, that's when it happens. But pre-seed and seed, you normally don't do anything in that range at all. And then after that point, you get to the series A, B, C. This is where like the valuations actually take place, the price rounds take place. And series A, B, C are where the company grows, right? You normally get acquired sometime during that time if you do have an exit, right? But a lot of companies nowadays are staying private, even though how big they get, right? SpaceX, OpenAI, just some examples. But there's a reason for that. Normally, this is just a way of like building up your company, getting bigger, and getting more valuation for buying other companies, paying your employees, just for the amount of work that you're doing. So this is when the company is actively growing. Then if you're a startup, you can have your good exits, which is an acquisition or an IPO, or you can have your bad exits. I'll talk about the bad exits in a second. A good exit would be an acquisition or an IPO. These are very famous, right? This company buys another company, they agree on a valuation, they sell it, everybody, like investors get money, you get money back. And here's a caveat, right? Just because I mentioned the example of BeReal, it looks like a good acquisition, but actually it wasn't because of something called preference stacking. So what happens is that once you get to a certain point, typically around Series A, B, whenever you raise capital, you have to promise the investors a certain amount back. Normally it's like, hey, you put in 40 million, I promise you that you get twice of that back when you get it back. So when they sell, let's say you sold the company for 100 million, then guess what? 40 times 2, 80 goes back to the investor, and you get to keep the rest, and you divide it up. So it is a good amount of money, but it doesn't mean like, hey, you get like all 100 million, right? So BeReal's fault was that their liquidation, or like their preference stack was very high, and they had to sell it for a valuation that was lower than what was projected. So if they had preference stack of like 5 times, for example, a very high preference stack, which means the investors need to get 5 times of what they put back. Let's say they did that at a $5 billion valuation, $1 billion valuation, but they only sold it for 500 million. That means they sold it for half of what they expected, and on top of that, they had to give back investors like 5 times what they originally put in. So that ended up killing them because there's no money left for the founders. So that's why the founders walked back with zero. So that was like a less of a good acquisition, more like a fire sale, which that is how I categorize it. IPO is also a good exit, right? Because you are open to the public market now, which means you can liquidate your assets if you want to. So the main issue is like if you have shares in a startup, a lot of times it's illiquid. You are only able to sell at secondary markets, and that is also a big if, right? But once you get an IPO, you can sell it to anybody. You can just go to Robinhood and sell it. So that's why an IPO is a good deal. There is a caveat, which is the lockup period. So Figma recently IPO'd. but I don't think the employees or the founders can sell shares for like 2 years, something like that. There's like something called a lockup period, so that people don't just sell their stocks as quickly as it balloons up and just walk away. So they have to hold it for 2 years. And Figma is down like 68% from what it IPO'd at. So I mean, they still are making a good amount of money, but like I think the founders, if it holds, they might lose billions of dollars. But I mean, they still are billionaires, so whatever. And let's talk about the bad exits. So this happens more often than you think. You read all of these things being like, oh, my company got acquired by Google or whatever. Turns out there was this acqui-hires. So what are acqui-hires? If your company is promising, you're very talented, people like you, but you're just not growing, or the company is slowly dying, what happens is a lot of times your investors will figure out something called an acqui-hire, like an acquisition for hire. So they will arrange that for you. They will be like, hey, I know somebody at Google. They're looking to buy like a small product or team so that they desperately need it, and they sell it. And a lot of times what happens is that it ends up being not too terrible for the founders, right? So a founder who might have had like a $20 million stake at the company might be acqui-hired, and they sell their shares of their company to Google, and then they get like a contract for 4 years for $2 million, which is still really good, right? Obviously, compared to most of the world. But compared to their original stake of $20 million, that's a big downgrade. But in theory, it looks amazing, right? If you go and read the news articles, oh, XS company was sold to Google for this much. Normally, when they do not mention the dollar amount, think of it as an acqui-hire. So if tomorrow a startup you're following says, oh, we got sold to this company, excited to join the team, I'm like, yeah, that's an acqui-hire. A lot of times, I mean, it doesn't happen all the time, but like if there's a dollar amount attached to it, like they say like, oh, this startup was sold for $50 million to Google, then you're like, oh yeah, they made a good amount of money. But if there's no dollar amount, then they sold it for cheap. The founders still got to keep a job. They obviously are still well compensated, but compared to the previous stake, whatever they're getting right now is not that good. And finally, you have the fire sale. Like Be Real, there's a bunch of companies, right? So they just decide that, hey, let us sell the company to whoever is the bidder, sort of like auction, and the investors walk away with maybe break even. A lot of times even they make a sale, like a loss. So it's not a great outcome for them. And so these are like the sort of exits, right? There's also like a final one, which is just be a good sustainable business. This is very uncharacteristic, right? Bootstrapping, or nowadays it's called seed strapping, which is just to raise a few $1 million, build a sustainable business, and just continue, right? Pay yourself like a couple of $100K a year. That is actually a very good outcome. And I think a lot of people should consider that, because you don't always have to go the venture scale and like become the next big thing. You can be very comfortable, not raising crazy amount of money, not becoming the zombie companies, as they call it. Like there are a lot of companies that are making like millions of dollars per year, but cannot raise another round of capital, cannot grow. They also cannot sell, because whatever the numbers they're getting for selling are way less than what they're valued at. So they effectively called a zombie company. So being a good, sustainable business is also amazing. Our B2B, that is a great company. Bootstrapped, $25 million ARR. That is like the gold standard, right? You want to be someplace around there. So a few things on what you should do. If you are raising money currently, know the terms inside and out. Do the due diligence in your end. Structure your company and take care of tax stuff like 83B election. 3B election just means like you're paying the taxes for your shares of the company that you founded upfront. So, you don't actually have a tax hit later on. If you're considering a startup, figure out what is the current ownership, dilution, preference tax. How much runway do you have? Figure all of that out. Super important. If you want to minimize taxes, do your due diligence. You can ask ChatGPT and Gemini about this actually. Gemini is really good because they index a lot on like Google search queries, so you can learn a lot about it. Look up the QSBS, Qualified Small Business Tax Incentive. If you have shares of a company before it is valued over $50 million and you hold it for at least 5 years, you can sell up to $15 million of it tax-free. It used to be 10 million, but after the one big beautiful bill that came out earlier this year, the amount went to $50 million. So you can actually have $15 million of shares tax-free thanks to that incentive called QSBS. Take a look at it. I recommend Ankur Nagpal. He has a company called Carry, really good personal finance guy and also knows startup finance really well. Follow his content, a lot of taxes there. And finally, if you want advice, reach out to me. I'm very happy to answer anything. I've answered a lot of questions before, but I'm very open to this, and you can reach out to me. You can just email me on Substack, pratikkarki@substack.com. So final segment, because I have to wrap up as well in the next few minutes. What have I been reading, watching / playing? The main thing that I watched was Pluribus, created by Vince Gilligan, the creator of Breaking Bad and Better Call Saul. Great show. A very interesting concept. A lot of different topics explored, right? Individualism versus communal system. Communism, actually, is very interesting. AI, like it can be an allegory for like AI. It's super interesting. I recommend everybody watch this. And I read this amazing paper on using pre-trained LLMs versus having the best post-training data available and augmenting pre-trained LLMs to look at chest x-rays. And these researchers, they built an agent called Checks Agent, and that looks at the chest x-rays. And they built one of the best data sets called Checks Instruct, I believe. And they were able to build one of the best classifying models for chest x-rays, and is really good. So I recommend that to everybody. Please read this paper and watch Pluribus. Links are in my Substack. And finally, thank you all for joining this episode. I'm happy to take any feedback, or if I left anything out, or if I didn't answer all of the questions, or if there's still like a lingering thread. Please message me, email me, whatever. Very happy to answer any questions. Thank you so much, and I'll see you next week.